I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, a new blow to big tech. The Senate has subpoenaed the CEOs of Facebook, Google, and Twitter, calling on them to testify about the content on their platforms. We will have the latest from Washington. Plus, restaurants are reopening in San Francisco and New York at limited capacity indoors, but just how many will actually survive the pandemic? OpenTable CEO Debbie Su will be my guest. And rents are plummeting across cities, and the outlook on real estate from urban centers to suburbia is murky at best. Former Zillow CEO Spencer Rascoff joins us to talk about his next act and his SPAC ambitions next. But first, let's get a check on the markets. U.S. stocks climbing today, led by big tech. Bloomberg's Abigail Doolittle joins me now from New York. Abigail, we're still waiting for those jobs numbers, the last jobs report before the election. Also, some hope about potential new stimulus funds. How are investors digesting all of this?
Well, certainly more volatility, Emily, the theme of this year, the theme of the third quarter, and apparently the theme of the fourth quarter, because it was up and down, especially for the Dow. The Dow at one point up nearly 1%, then down a bit, down about 0.3%. This tells you lots of uncertainty around the fact that we still don't have another round of stimulus. Of course, the jobs report tomorrow. Jobless claims today came down a little bit, but still well above pre-pandemic levels. Relative to that jobs report tomorrow, it looks as though September is expected to be a little bit less good than August. 875,000 jobs are expected to have been added in the month of September versus 1.37 million roughly added in the month of August. Of course, we'll be looking for revisions also. And, of course, the jobs picture is going to be a huge key to the economy going forward. All of this, as it appears as though we might be on the cusp of a second wave of layoffs, because, of course, yesterday, Goldman Sachs announcing that they will be cutting 400 jobs, or about 1% of their workforce. So not a huge percentage, but just the idea that they are moving in that direction. Disney, of course, 28,000 workers, Allstate, 3,800 workers. Of some encouragement, though, today, Emily, the Gap did come out saying that they are going to hire 50,000 seasonal workers in the first half. I'm not exactly sure how that will work around the holiday and then into the first half of 2021. The hiring will be done in a safe virtual way. If they're hiring 50,000 people, you have to believe that they think folks will be out in one form or another buying their products, discretionary items, of course, clothing. So that might be one encouraging sign, especially as there are some signs, particularly here in New York, that the virus, that there are these pockets around. So everybody waiting to see whether or not, a second wave of the virus will in fact start here in the U.S.
Absolutely. And of course, going into winter, increasing concerns about that and the cold and flu season. I want to talk a little bit about big tech, though, because big tech really led the gains today. This on the back of the CEOs of Facebook, Google, Twitter getting subpoenaed by the Senate. So facing more scrutiny from Washington. Didn't seem to impact the stocks, though.
It certainly did not. The NASDAQ 100, in fact, led all day long, up for a second day in a row. At the end of the day, up about 1.4% relative to the Dow, up just about 0.2%. So huge outperformance by the mega caps. So investors signaling that they really don't care about this subpoena. So earlier this morning, I broke the news that the Senate committee panel was voting on this. And then, of course, they unanimously passed it to bring in Mark Zuckerberg and Sundar Pichai and Jack Dorsey to testify about a legal shield that is key to their business models. The fact that this is happening, I think some of it might be political. One of the statements I read, you literally used the statement on the eve of an election. So again, some political motivation here. I think, Emily, at this point, the reason that you're not seeing these stocks sell off, and look at Twitter there, up 4.9%, really a big day. And of course, social media being used so much on the eve of the election. This is, it's probably thought that it's unlikely that the Senate is going to somehow break up big tech or regulate big tech anytime in 2020, maybe even 2021. We, of course, have had a couple of years now where these CEOs have been going before Congress to testify, and whether or not there is, some monopolistic concerns or if there should be antitrust provisions put into place. So we've had the shot across the bow. The question of when does it happen? Probably not in 2020. Those stocks up in a big way, Emily.
All right, Bloomberg's Abigail Doolittle, thank you so much. More on those subpoenas now from Washington. A Senate committee again has voted to subpoena the CEOs of Facebook, Google, and Twitter. They will be asked to testify on a legal shield that is key to their platforms' business models. The Senate Commerce Committee compelling appearances by Mark Zuckerberg, Sundar Pichai, and Jack Dorsey after the companies wouldn't agree to send them voluntarily. To discuss, we are joined by Bloomberg's Ben Brody, who covers tech lobbying in the Capitol for us. So, Ben, what exactly does this mean? When exactly would they have to testify before Congress?
Well, I think Abigail exactly nailed it on the head. The Republicans are pushing really hard to bring the CEOs in, or at least to, pipe them in via remote ahead of the election. They want to talk about their allegations of anti-conservative bias in the way that these companies moderate posts and content on their platforms. And so they want to do that ahead of the election. They want to talk about how it's all sort of a Silicon Valley plot to bring down Republican and right-wing talking points, and they want to do that this month.
So that said, would this actually happen before the election? And there will be a different Senate very soon. So why do this now?
That's a great question. I mean, I think that there's a lot of efforts on the Republican side of the aisle to try to push some of the political issues ahead of the election. That's something you get always in the election. And for the time being, the Republicans are in control of the Senate. The Democrats do not want to do this ahead of the election. They are looking forward to next year when they may even be in control of the Senate. So it's not clear that they necessarily want to do that right now. But if the Republicans choose to bring them in, then they probably can. It's worth noting that they haven't officially issued the subpoenas. There's still some negotiations going on, but they have proceeded to basically get the authority that they can issue them if the CEOs aren't willing to come in.
Meantime, the House Antitrust Subcommittee has been working on their review of big tech on the back of that big hearing with the CEOs of Apple, Amazon, Google, and Facebook. Do we know when we will see that report, and what will the conclusions be?
So it's a busy time here in D.C. with the tech companies. So you also have that antitrust hearing. Congressman Ken Buck, a Republican from Colorado, told Bloomberg earlier today that it's going to be next week. That's what our sourcing had told us as well. And so, we're looking at a number of issues that they may be putting into this report. It's not clear to us that it will be bipartisan. Mr. Buck said that he wasn't sure yet and he hadn't seen the report. But there are a number of issues that we think, could come up, and maybe the Republicans could sign on to some of them, not to others. The Republicans today said they didn't want to sign up to breakups, things like that. One of the things we might be looking for, and this might be Democratic only, is this idea of kind of separating a marketplace from a participant. So Amazon runs a marketplace for outside vendors, for third-party sellers, and it makes up a huge part of its sales volume. But Amazon also competes against them, and there's been talk, at least in Democratic circles, about potentially separating those two ideas.
Now, what's interesting about this big tech scrutiny is that it is coming from both sides of the aisle, but for different reasons. The Republicans are concerned about free speech. The Democrats are concerned about misinformation. I spoke with Tennessee Senator Marsha Blackburn yesterday. Take a listen to her concerns in particular.
We have to make certain that the internet, if they're going to say they are the public square, then we need to make certain that there is a good cop on the beat in that public square. We need to address privacy issues. This is something that we're going to do on a bipartisan basis. We hope the House will join us on that. When it comes to finding out utilization of data, how we are handling much of what is happening with COVID, we need more information.
Now, again, the reasons are different, that you've got lawmakers from both sides of the aisle concerned about big tech, but how big a concern is it for big tech that they're getting scrutiny from all sides?
Absolutely. I mean, I think it's going to be a really fascinating dynamic here in D.C. next year. You have all those things on the table that Senator Blackburn was talking about. You have antitrust on the table. You have Section 230, that's their content moderation. You have privacy. You have their ties to China. These are all things that are really on the table next year, and they're kind of on the table regardless of whether Vice President Biden wins or Donald Trump wins another term. I think there's going to be a real push forward on these things, of course. If Republicans are in power, both in the Senate and the White House, you'll have other things. But, I think they're going to be facing these things no matter what.
All right, Bloomberg's Ben Brody covering all of this back and forth over big tech in Washington. Thanks so much, Ben, for your reporting. Coming up, indoor dining has just reopened in San Francisco and New York at limited capacity. We're going to talk to the CEO of OpenTable about how they are supporting restaurants during this time. That is next. This is Bloomberg. In a highly anticipated event, restaurants across San Francisco and New York were able to reopen indoor dining today. In a sector hit hard by COVID, the restaurant industry is hoping that indoor diners will increase revenue and sustain establishments while moving into the colder months. For more on the pulse of the dining industry, we're joined by the CEO of OpenTable, Debbie Su. Debbie, great to have you with us. Obviously, this is a tumultuous time for restaurants. Obviously, great news for them that they can open even at limited capacity. But, OpenTable has been very forthright about just how difficult this period is going to be for the restaurant industry. Just how bad is it? What trends are you seeing? Where are you seeing pickups and slowdowns?
It's pretty bad. Even before the virus, restaurants were operating on razor-thin margins. And now added on to that are the capacity constraints and the added costs for all the safety precautions that restaurants have to be taking. It's been a really devastating time. And if you look at restaurants, even just in San Francisco or the Bay Area, it's been gut-wrenching what's happening there, both because of the virus and because of the fires. Their outdoor dining activity has decreased because, the outdoor air quality is poor. So there's never been a more difficult time, I think, to be in the restaurant business. At OpenTable, as you mentioned, our mission really is to help restaurants forge through this crisis as best we can. To that effect, we've waived our subscription and reservation fees and launched a myriad of products to help restaurants run more productively, efficiently, and safely.
Now, you told us last month that you see 1 in 4 restaurants completely closing out of this, that reservations have been down, seating down 80%. Is that still the case? Is it getting any better or worse?
In markets like San Francisco, dining activity is actually down 88% compared to down 43% for the US as a whole. In markets like New York, down 89%, Seattle's down 81%, Chicago's down 75%. So there are a lot of cities and big cities in the US that have been really, really impacted by this in terms of dining activity. We do see pockets of growth and activity. What we've seen is as restrictions lift and people feel safer and more comfortable dining out, they do dine out. In a recent OpenTable survey, we actually found that 25% of survey respondents in the US and Canada are dining out at least once a week. So there are some glimmers of hope here. Other trends we're seeing is that outdoor dining has really picked up. So if you look at dining in September of this year versus September of last year, we've seen an 18x increase in parties sitting outside.
So how do you expect the restaurant industry to look different after this? I mean, we don't know when life is going to go back to normal. We don't know what normal life is going to look like. I mean, are people going to go back to restaurants as much as they ever did? I mean, will it ever be the same?
We are going through an evolution of what dining out means right now. And I think there's never been a more important time for online reservations or restaurant tech companies like OpenTable helping restaurants, again, run safely and more efficiently. I think some of the trends that we're currently seeing during COVID are likely here to stay. Restaurants, love taking online reservations because it makes their business run more efficiently and seamlessly. And trends like contactless pay or not having to check in with a host or online menus, those are all things that I think we'll continue to see. Also, the rise of delivery and takeout, as we've seen during COVID, I think will persist as well. It's become a meaningful and significant part of restaurants, businesses, and their P&Ls, and it's a way of dining that users and diners are more used to.
Now, there are some interesting things happening. Restaurants that never before took reservations are now taking reservations. You've also got winter around the corner. I know you're just weeks into this new job. You've got a lot on your plate, so to speak. What are you expecting through the colder months in particular, given that so many of these restaurants have been relying on an outdoor experience to make rent?
Yes, so the coming of winter and colder months is very much a concern for many of our restaurant partners. I have to say, though, the level of innovation and ingenuity that we've seen from our restaurant partners is nothing short of brilliant. So we're hearing stories of outdoor dining bubbles or yurts or tents, sophisticated air purification systems for indoor dining, and of course, like I mentioned, the prevalence of takeout and delivery. Restaurants are doing everything they can and being super scrappy and pivoting to figure out how to stay afloat during this time. But it will be hard. The winter will be difficult, but it is encouraging to see how creative restaurants are doing this. And even in San Francisco, restaurants like Epic Steakhouse, Water Bar, or The Vault, they've transformed and expanded their outdoor dining areas. And it's just been really remarkable to see.
Human creativity has been remarkable to watch through this pandemic. Debbie Su, the CEO of Open Table, thanks so much for sharing your thoughts with us. We'll get back to you in a few months for an update. Hopefully things will get better. Okay, coming up, another big Adtech acquisition making headlines in media. TransUnion agreeing to buy TrueOptic, what it means for the world of streaming and more. I'll catch up with Andre Swanston next. This is Bloomberg. With COVID accelerating the shift to streaming, Adtech is in high demand. TransUnion announcing it's buying TrueOptic today, a premier data-as-a-service provider across streaming television, audio, and gaming. Co-founder and CEO Andre Swanston is with us now to discuss what this means in the patented household graph that TrueOptic has created. Andre, great to have you back on the show. Obviously, TrueOptic has a lot of really interesting data on consumers and what they're watching through your integration with OTT services, gaming consoles. But why is a credit bureau buying TrueOptic?
Well, a company like TransUnion really works with helping consumers and companies better understand how to leverage data in a safe way, and kind of serves as a safe haven across multiple industries. And I think, I don't want to, I'm not a TransUnion employee, so I'm not going to put words in their mouth, but I believe that they understood that the ways that people or companies, brands are leveraging data is dramatically shifting to streaming media and powering advertising. And TrueOptic is the leader in data as a service and identity across connected TV and streaming audio and the connected home. And it was a great way to complement their strengths with our strengths in the fastest growing part of the ecosystem.
Disney recently sold an ad tech company it had acquired through buying 21st Century Fox. There's also more M&A in your space happening in general. Why is that?
So we've seen even pre-COVID, the growth of advertising across streaming media. Connected TV gets a lot of the press, but streaming audio growing just as fast or even faster in many instances. And really what you've seen with cookies, web cookies going away, device IDs for mobile devices like Apple's recent announcement, going away, you've seen pretty much an arms race start to better be able to understand how to leverage data across the connected home, how to reach individuals. And if you look at the strategy of a lot of the major media companies, it's been how can they better operate or adapt to where their consumers are going. And where both TrueOptic and TransUnion have played is kind of these impartial, unbiased sources of truth for data and insight. TransUnion more historically in the offline world and TrueOptic in the connected world. And so, as part of that arms race and as part of wanting to stay impartial, I think this deal is allowing the companies to stay true to who they are and be able to service all those media companies and agencies and brands that are so dying to figure out how to have consistency across these capabilities.
Now, you have such a unique view into trends in the new media landscape. You're often on the show talking about Disney versus Netflix and how the streaming wars will play out. Disney just laid off 28,000 people at its parks yesterday. Disney Plus is doing well, but we don't know how well and whether it'll make up for the revenue shortfall at the parks. Based on what you are seeing, who is going to be left standing of the streaming players, and who will perhaps not thrive through this crisis?
Yeah, so my answer may be counterintuitive to what a lot of people say, but I think I have, like you mentioned, pretty unique insight. I think pretty much everybody who's providing ad-supported content and that is widely distributed is going to win. I think there's actually still room for new entrants in that. You've seen just recently Peacock and others have really successful rollouts. And I think the big differentiator for companies over the next 12 to 24 months are going to be the ones that have the ability to, at scale, with accuracy, with security and privacy, leverage data to provide more value, not only to the advertisers, but to the consumers. So by having relevant advertising, by having transparency, that increases the capability for the consumer and provides more value to the advertiser. And so, it all circles back to the content wars are going to be the content wars, and you either have it or you don't. But even if you do, if you don't have the ability to appropriately monetize your content, you're in big trouble. So there's lots of room, and I think announcements like these and the work that TransUnion has done to build up this capability, we're not the first acquisition. They acquired a year and a half ago a company called True Signal, just a few weeks ago, Signal. And then now with TrueOptic, I think we'll be able to service the needs of all these big companies.
All right. Andre Swanston, congrats to you, TrueOptic co-founder and CEO. We will be tracking your progress. Coming up, with the flexibility of remote work, are Americans leaving the cities in droves for more affordable and safer pastures? We'll talk to a Barclays analyst who thinks that's a myth. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Apartment rents are plunging in high-cost cities from New York to San Francisco. That's according to RealPage. Now, places that were less popular before the pandemic are suddenly in high demand as Americans turn toward remote work. But data from Barclays says otherwise. Joining us now to discuss his latest note entitled "The End of the City is an Urban Myth," Ryan Preclaw, head of investment sciences at Barclays. Ryan, thank you so much for joining us. So what is a myth exactly?
So I think the myth here is that people don't need to be worried about the general decline in cities.
Looks like we've lost Ryan. Ryan, can you hear me still?
I do have you now, yes.
There you are. So what exactly then is happening in urban areas?
So I think what we're seeing is that if you're talking about most urban areas in the U.S., they have actually continued to see price growth along with the suburbs. So of the big cities in the U.S., only New York and San Francisco have actually seen a price drop on average since March.
So talk to us then about where you see these trends going. I mean, obviously, I think anecdotally, as someone who lives in an urban area, there does seem to be a desire to leave the city and a desire for greater flexibility. And the fact that more workers are now able to work from home, potentially some of them for forever, there's also that ability. So how exactly do you see this playing out?
Yeah, so we see two things. The places where people are going now seem to be places where they get more access to the kinds of amenities that they like in cities: restaurants, bars, cultural institutions, things to do. But because of COVID, those things are closed in a lot of the really big cities. And what we're seeing is that people are actually willing to pay more to go places where those things are still open. So obviously that's bad for those big cities right now, but it does suggest that once COVID is passed and cities are able to reopen, that you're going to see people want to come back and have those things again. I think the other side of it is that, the numbers that we're talking about here in terms of the long-term shift to work from home are still pretty modest. I think if you want to put it on a scale that is in terms of prices, for most of the past decade, urban prices grew 1% to 2% faster than suburban home prices. We think that the shift of migration could bring those in line so that, going forward, they both rise, but they kind of rise together. And you've seen something like that since March. So since March, prices for both are up, but urban is trailing by a little bit less than 1%.
So should you buy? Should you sell right now? Should you just stay put and wait it out?
So, look, we think that one of the big stories for the post-COVID period is that affordability is going to stay high for a long time, and that's going to boost house prices in both cities and suburbs.
All right. Fascinating and somewhat counterintuitive. Ryan Preclaw, head of investment sciences at Barclays. Thank you so much. We're going to get to more of this a bit later in the show. We've got Spencer Rascoff, former CEO of Zillow, with us in a few minutes. But first, as we've been covering, the Senate voting today to subpoena the CEOs of Facebook, Google, and Twitter to testify on a legal shield key to their business models. Congressman Ken Buck of Colorado spoke to Bloomberg's Kevin Cirilli earlier about the Senate's next move.
The antitrust subcommittee will be issuing a report next week. It may be bipartisan. It may not be. We haven't had a chance to read the report at this point. I think what we learned today was that the experts, the professors, the former regulators, the people who really study this area see a problem with high tech and the anti-competitive behavior of at least 5 of the platforms in high tech. We also learned that while most return on capital for most industries has stayed pretty stagnant for the last 50, 60 years, big pharma and high tech have really exploded. And we've got to make sure that we keep high tech competitive so that smaller, innovative companies can compete.
There's been so many conversations just about freedom of speech, as well as just how big these tech companies are and how they're able to navigate Section 230, for example. Where does that fall into this, especially as you get ready to release your report?
So I think there are issues that are more talked about on the left and more talked about on the right. And bias and the regulation of speech on these platforms is certainly talked about a lot by conservatives because they feel like they are being discriminated. I should say we feel like we are being discriminated against. On the left, they talk about the size of these companies and the danger of having companies that are that big. My view is that if we do the right thing with reducing the anti-competitive behavior of these companies, we will see an impact on free speech. We have a lot of different sources of TV and a newspaper for our information. We don't complain about bias in those areas because we know when we look at one or the other, we're going to get a different viewpoint. It's when one platform controls and there's no other platform that can give a different viewpoint that we really have a problem.
Are subpoenas going to be necessary?
I think the investigation side at this point is over because we're dealing with a new Congress starting January 3rd. And so what we're going to see are probably some legislative proposals that will be made in the November-December timeframe. And then really in January 3rd, the results of this investigation will move forward depending on who controls the White House, who controls the Senate, who controls the U.S. House.
You look at some of within the big tech industry, you've got Spotify and other companies engaging in an alliance, for lack of a better term, in terms of going after some of these big tech companies on their app platforms and just where apps are placed. I mean, how do you navigate the quickly evolving world of technology and keep pace with it? And this is something that conservatives have been talking about for forever, and keep pace with that evolving world and also make sure that it's fair for small business and entrepreneurs to create more anew.
Yeah, I think what's really essential is to understand the separation of powers in our government. The Congress's role is to make sure that the executive branch has the resources they need to move forward and that the laws are applicable to the current economy. If we do those two things, that's our job. We can't say that this company should be broken up or that the result, the remedy, should be this particular remedy for this situation.
I want to switch gears now just to go geopolitical for a second. It's one thing to look at the domestic big tech companies. It's entirely different to look at China's big tech companies and the infiltration that they have and penetration that they're having, not just in the U.S. marketplace, but also in Europe as well as all around the world. What does the U.S. need to be doing to make sure that our own intellectual property is protected from the Communist Party of China?
Well, I think we need to do two things. One, regardless who the president is, we need to make sure that if China bars U.S. companies from entering its marketplace, like Google, like Amazon, like some other high-tech companies, we need to make sure we take reciprocal action and that China doesn't have a free pass with TikTok or other apps in this country when they're barring us. So the first thing is fair trade policy. The second thing is we need to do a lot better job, and the world needs to do a lot better job of protecting intellectual property from China. They have been predators, they have cheated in the marketplace, and we need to get a consensus around the world that China has to come into the free and fair trade areas and not allow them to continue to cheat.
Congressman Ken Buck there of Colorado. Meantime, we've just gotten some breaking news from Amazon, the company just publishing a blog post about their COVID-19 testing efforts and results. Amazon has been under a lot of pressure to test its employees and to tell the general public how many employees are actually contracting COVID-19. The company saying of its 1,372,000 frontline workers at Amazon and Whole Foods, 19,800 of them have tested positive for COVID. The company saying that's actually 42% lower than the general rate of COVID that's surfacing in the general population. Again, Amazon saying 19,800 employees have tested positive for COVID. We're going to continue to follow the headlines coming out of this new information coming from Amazon. Meantime, coming up, finding your second home might have gotten a bit easier. We're going to hear from Zillow's co-founder and former CEO about a new platform aimed at making vacation more of a reality. That is next. This is Bloomberg. Rents are plunging across major urban areas in the midst of the pandemic, while demand is rising in suburbia. And for those who can afford them, second homes have been an oasis. For others, just a dream. Enter Picasso, a new startup aimed at helping people buy into and manage second homes at a fraction of the cost through co-ownership. With us now, Zillow's co-founder and former CEO Spencer Rascoff, who's launching a new startup today, Picasso, with his former Zillow colleague, Austin Allison. Spencer, great to have you back on the show. Obviously, COVID is changing a lot about how we live our lives, how flexible our lives can be. How exactly does Picasso work?
Sure. Well, you're right. I mean, COVID now has us untethered from our corporate headquarters. People can now live and work where they want to live. So the way Picasso works is we take this very underutilized asset, which is second homes, and we try to increase its utilization through co-ownership. So what that means is maybe if you've been thinking, gosh, I would love to have this vacation home. It's $500,000 on the lake, an hour away, but does it really make sense? Am I going to use it enough? Can I afford it? Instead of buying the whole house for $500,000, maybe buy half of the house or a quarter of the house. Picasso will buy the rest, and then Picasso turns around and resells its portion to other co-owners. You then use the Picasso owner app to schedule your stays, and Picasso does the property management. So it allows second homeowners to right-size their ownership of the home. Rather than owning 100% of a home, you're only going to use a fraction of the time, own a fraction of the home.
That said, we're in a recession. You've got tens of millions of people who've lost their jobs. You've got a lot of uncertainty about what's happening next week, let alone next month or next year. How many people can afford a second home right now or want to make a big decision like that, even if you're only talking about 1/8 of the cost?
Sure. So, I mean, historically, second homes, which are this joy to own, have only been accessible to the 1%. And what Picasso aims to do is to make it accessible to the 10% or the 25% or the 50% through co-ownership. So, if you do the math, if you think about, say, a $500,000 second home, that you're buying perhaps a quarter of, and you're financing with a mortgage through our mortgage partner, you're only putting down $50,000 to $100,000 to have access to, say, a quarter of a $500,000 home. So it is achievable. And especially now when people are being more flexible about thinking where they want to live, it's as you said in the beginning of the segment here, second home ownership is a huge oasis for people, especially in a COVID period. And I don't see that changing. I actually think that we're entering really a permanent state of kind of flexible living environment where people now are reconsidering what their living situation is. And this makes second home ownership, maybe not full second home ownership, but I believe partial second home ownership, incredibly appealing.
Now, obviously, you co-founded Zillow. You were the CEO for a decade. What is your outlook on the real estate market? We're hearing these conflicting narratives. One, it's the end of the cities. One, that's a myth. Should you buy? Should you sell right now? Should you just stay put and wait this out because it is so uncertain? What do you see?
Yeah. So, I mean, the truth is that nobody really knows, right? I mean, there are a lot of pundits, including me, speculating about this. But if you tell me what's going to happen to companies and how much they'll require people to be in the office, I can tell you what's going to happen to housing. Now, I have a point of view, which is that companies are going to switch to a hybrid model where employees are in the office maybe 1 day a week or 2 days a week, or maybe 1 or 2 days a month for kind of more knowledge workers or tech companies. But the idea of you being tethered to a corporate office, a corporate headquarters, and going there every single day, 9 to 5, I think that's going to go the way of personal offices, sort of what personal offices were to the 80s and open offices were the 90s and 2000s. I think you're going to see this hybrid model. And if I'm right, then I think you're going to see people moving not to the woods necessarily, but outside of a city center to the suburbs. So you don't have to live in San Francisco, you can live in Napa Valley. You don't have to live in Santa Monica in Los Angeles, you can live in Santa Barbara. You can live an hour or 2 hours away from your office if you're only commuting there 1 day a week or 2 days a week. And if self-driving cars become a real thing in 5, 10, 15 years, then that commute becomes even more productive and you'll see even more spread away from city centers into the suburbs and more rural areas.
Meantime, you've got very interesting things happening in the public markets. And again, huge measure of unpredictability, though somehow they keep going up. You just filed to go public with your SPAC, Supernova. You haven't found a business to merge with yet, but what are your intentions and ambitions here?
Sure. So I'm in the quiet period right now with my SPAC, so I have to be very limited in what I can say. What I can say is that I think it's obvious that SPACs and direct listings, and I'm on the board of Palantir, which went public yesterday through a direct listing, but SPACs and direct listings both offer an interesting alternative way for a private company to go public. And I think they'll continue to gain market share at the expense of traditional listings. So I'm long-term bullish on SPACs. I think they're a solution to some of the challenges that traditional listings come along with. But in terms of what specifically Supernova might be up to after we go public, you're going to have me back on your show, Emily, to answer that question, hopefully in a couple weeks.
But what? Okay, let's talk more broadly then. What about the diligence? I mean, the diligence process is completely different than it is for a traditional IPO. How can we know whether to trust these companies, whether this is a good investment?
Well, there are two pieces to diligence with SPACs, right? There's when the SPAC goes public, when you're right, there's not much to diligence except the management team and make sure that the financials are audited, but there's not much to see there because there's no operating business. And then there's the time of the SPAC merger where the SPAC merges with a private company. And then there's plenty to diligence at that point in time because there's an operating business to evaluate. As I say, I think SPAC mergers and companies going public through SPACs are a really good alternative to a traditional listing. But you'll have to wait for me to talk in more detail just because of the restrictions of the quiet period.
Now, got to ask you before you go about Palantir. Obviously, they took the direct listing route, the unconventional route. The shares didn't quite hit that market cap or the valuation that they fetched on the public markets back in 2015. Do you think a direct listing was the right call, and can they get there?
Yeah, I think a direct listing was the right call because they didn't need to raise primary capital. So like Asana, Palantir had plenty of money in the bank, and so they didn't need to sell shares in the IPO. So a direct listing is a much more orderly way to move from the private markets to the public markets than a traditional IPO if you don't have to sell stock at the time of the listing. It was a very smooth offering. The company is now publicly traded. There's liquidity, And I think the company's off to a really good start in this next chapter of its growth as a public company. So I think it was a smooth day. Yesterday was a good day for direct listings, with two companies executing really well with their direct listing model.
All right, Spencer Raskoff, Zillow co-founder and executive chair of Picasso, will follow all of your second acts, as many as they are. Thank you again for joining us on the show. Back to some of that breaking news out of Amazon. The company just releasing some hard numbers about the results of its extensive COVID testing. Amazon has been under a lot of pressure to reveal just how many workers are testing positive. The company saying almost 20,000 frontline workers at Amazon and Whole Foods have tested positive for COVID-19 over the course of the year. Amazon's run a lot of its own testing efforts, created its own tests. They're trying to sell this as they're doing a good job, saying the number is 42% lower than the number you would expect if their COVID rates were the same as the general population, though we do have our own reporting from back in June, where at some Amazon warehouses, the cases of COVID exceeded the infection rate in the surrounding communities by several times. We're going to continue to follow this story, bring you more developments as we have them. Still ahead, which tech employees think their company is getting diversity right? We're going to talk to the CEO of Glassdoor about their new D&I rankings next. This is Bloomberg. In the midst of the Black Lives Matter and Me Too movements, diversity has increasingly become a front and center issue for many tech companies. But what is less widely known is whether employees are satisfied with how their workplaces are handling it. Glassdoor is now unveiling its first diversity and inclusion rating system from workers at big tech firms like Amazon, Facebook, and Google. Joining us now for more, the CEO of Glassdoor, Christian Sutherland Wong. Christian, thank you so much for joining us. So looking at the rankings, Salesforce at the top, Uber right now at the bottom, Amazon towards the bottom, somewhere in between. What trends did you see in employee feedback, and what led to higher versus lower results?
Yeah, so, we, Glassdoor, are the leading platform in workplace transparency. And for the longest time, we've been tracking all forms of ways people describe their workplace culture. And from the very beginning, when we launched 12 years ago, one of the key ways people talk about their company is regards to how well they're doing when it comes to diversity, how well they're doing when it comes to inclusion and belonging. But more recently, particularly in the wake of the George Floyd murder, we saw a huge spike in reviews mentioning diversity, inclusion, racial justice. In fact, we saw a spike of more than 63% of these mentions in our reviews. And so we went out and we talked to job seekers and we asked them, what are the factors that you consider when you make a job and choose a job? And 3 out of 4 of them told us that one of the most important factors in deciding where to work is diversity. And so with that, we're now rolling out a whole set of new features today, which provides transparency across all companies across the world on how they're going with diversity and inclusion.
Now, there's a big controversy unfolding in Silicon Valley this week. You've got the CEO of Coinbase, Brian Armstrong, saying the company will not be addressing social issues in the workplace. We won't take on activism outside our core mission at work, he says. Other CEOs are pushing back. Jack Dorsey saying that this will leave people behind, that social issues should be considered in our work. Do employees want their companies to be taking a stand on these issues? Will Coinbase be on the wrong side of history?
I think you're hearing pretty clearly that employees do care about issues when it comes to diversity and inclusion in the workplace. They want a voice. They're telling us they want a voice. They come into Glassdoor to write reviews on it. And what we've seen over the course of our experience is that providing more transparency is a positive force for good in the world. We typically find that when we hold companies accountable, provide transparency, we hold them accountable. People tend to do bad things in dark corners, not in broad daylight. And so we believe shining a light on workplace diversity and inclusion is going to be a good thing. It's going to give employees a voice. And we believe the best companies are going to come back and they're going to participate in the conversation.
You're also launching some new products to provide greater transparency, like the opportunity or the option to hide your own demographics when you're filling out these surveys. Do you think you'll get more information that way, a more complete picture?
Yeah, so among the features that we're rolling out today, one is a specific rating around how a company is doing, specifically with diversity and inclusion. But the other one, which is really exciting, which you mentioned, is also we're giving our U.S. Employees the option, if they choose to anonymously tell us their demographic data. So that could be their race, ethnicity, gender identity, sexual orientation, among other things. And the goal here is that what we can do by collecting this data over time is that to give you a view into a company, not just from what the average person is telling you about this company, but specifically what particular groups or underrepresented groups have in terms of an opinion about a company, which we think is a key insight for many users as they evaluate where they want to work.
All right. We'll take a closer look at those rankings as you continue to build them out. The CEO of Glassdoor, Christian Sutherland Wong, thank you so much for joining us, and thank you all for watching this edition of Bloomberg Technology. I am Emily Chang in San Francisco. Bloomberg Daybreak Australia is next. This is Bloomberg.